everyone, and welcome. Today, we're diving into a really cool project called YModel Playground. It's basically trying to answer that age-old question. Can we actually use artificial intelligence to make sense of the wild, chaotic world of the stock market? Let's jump right in. So, this is the million-dollar question, isn't it? Can a machine, an algorithm, really outthink the millions of human traders, the emotions, the news, the everything that drives the market every single day? Well, this project, YModel Playground, doesn't just ask the question. It actually builds a pretty sophisticated system designed to find out. Okay, first up, we're taking on what feels, well, impossible. Trying to predict the unpredictable. And the YModel Playground isn't just another shiny crystal ball. No, it's an entire framework, a whole system built from the ground up to find real patterns in what just looks like noise. Think of it like this. It's not one single algorithm. It's a whole assembly line. On one end, you feed it raw data, all the stock prices, economic reports, you name it. In the middle, you have the AI brain doing its thing, processing everything. And then out the other end comes a forecast. But, and this is the really important part, it's a forecast that's designed to be explainable. So, just like any good detective, the first thing our AI needs to do is gather clues. Its entire intelligence is going to be built on two fundamental pillars of data. And this is where things get really smart. The model is looking at two totally different types of clues. On one hand, you've got the stock-specific stuff from Yahoo Finance. The daily price, how much was traded, all the nitty-gritty details about that one company. But then, on the other hand, it's pulling in the big-picture economic data from the Federal Reserve. We're talking inflation, GDP, unemployment, the works. Because a stock doesn't live in a bubble, right? Its fate is tied to the health of the entire economy, and this model gets that. And we're not just talking about 2 or 3 numbers here. The framework automatically grabs and processes over 30 different macroeconomic indicators. It gives the AI this incredibly rich, detailed map of the entire economic landscape. It's really the difference between looking at a single tree and seeing the entire forest. Okay, so we've got all this data, mountains of it. But here's the thing. A raw number, like a stock closing at $150, is kind of meaningless on its own. The next super critical step is to turn all that raw data into intelligent signals, or what data scientists like to call features. A huge part of this is creating what are called technical indicators. You can think of these as special glasses the AI can put on to spot patterns in price and volume that we might miss. For instance, it's calculating things like RSI to see if a stock is overbought, or MACD to check on a trend's momentum, or even Bollinger Bands to see how volatile things are. These are the specific patterns the machine is learning to look for. But look, you can have all the best input signals in the world, but if the AI doesn't know what it's aiming for, what winning actually looks like, it's all useless. And this, right here, is where the YModel Playground gets really, really clever. The most important feature isn't an input, it's how the model defines a successful prediction. Let's get into the secret sauce. Instead of just trying for a simple up or down prediction, which is pretty basic, the project created a custom target they call Y_metaclass. It's just a much more nuanced, a much smarter way of telling the AI what a good outcome actually looks like. So how does this actually work? Well, it's a pretty neat 3-step process. First, the model gets to peek 32 days into the future. Then, using that future data, it calculates a kind of potential profit score. And finally, and this is the absolute key, it doesn't just spit out a number. It sorts that potential into one of 7 distinct levels, from a really bad drop at -3 all the way up to a massive rally at +3. This gives the model a much richer, more specific goal to shoot for. All right, so we've got our intelligent clues, and we've got a super clear goal. Now it's time to actually train our digital analyst. This is where we teach the machine to connect the dots, to find those hidden relationships between all those signals and the future outcome we just defined. And the engine powering this whole thing? It's a real heavy hitter in the machine learning world called XGBoost. It's incredibly popular because it's just fantastic at finding those subtle, complex, and not so obvious patterns in data, which is exactly what you need for something as messy as the stock market. But here's the thing, the market is always changing, right? A model trained on data from 2018 would be totally lost today. To get around this, they use a really smart technique called rolling window training. Basically, instead of learning once and being done, the model is constantly retraining itself on the most recent slice of data. It's like it's always reading the latest news to stay up to date. So the model can make a prediction. Great. But in finance, and frankly in a lot of fields, the what is way less important than the why. And this brings us to the final and maybe the most crucial part of this whole framework, prying open that AI black box to see how it's thinking. I mean, this is the classic problem that haunts so many AI systems, right? If the machine just spits out an answer, buy this stock, but can't tell you why, can you really trust it? Especially with real money? Probably not. And that's a huge barrier that this Y-model playground was specifically built to tear down. So to crack open that black box, they built in this amazing three-pronged approach to transparency. First, you've got something called SHAP importance. It's like the AI takes a highlighter and shows you exactly which factors, like maybe inflation data or recent price momentum, mattered most for this one specific prediction. Then there's permutation importance. Imagine you take away one of the AI senses, like its ability to see unemployment rates. This tells you how much worse its predictions get without that one piece of the puzzle. And finally, you have sharp ratio importance, which looks at the big picture and tells you which factors consistently help build a profitable strategy over the long run. It's a whole toolkit for building trust.
So let's wrap this all up. What makes this framework so compelling isn't just one single piece, but how it all fits together. It starts smart by mixing the tiny details of a stock with the giant economic picture. Then it cleverly turns raw numbers into meaningful signals, and it aims for a really sophisticated, multi-level target, not just a simple thumbs up or thumbs down. It uses a powerful, modern training method to keep itself from getting stale, and this is the big one. It's built from day one to be explainable, so you don't just get an answer, you get a reason.
And all of this leaves us with a really fascinating thought to end on. We're moving from AI that just gives us answers to an AI that can actually show its work. So the real question becomes, if an AI can clearly explain its logic, does that fundamentally change how we trust it with our most important decisions? Not just in finance, but everywhere. Something to think about. Thanks for joining me.